Silver just hit $85 per ounce, and if you're watching this on February 12th, 2026, you need to understand that we might be standing at the last major stop before silver makes a run at $100. I know that sounds dramatic, and after the catastrophic crash we witnessed in late January where silver fell 41% in 3 days, a lot of you are skeptical about bullish predictions. But I'm going to show you exactly why $85 represents a critical inflection point, why the next $15 could happen much faster than you think, and what you need to watch over the next few weeks to determine whether we're really heading to 100 or if this is a trap that's going to reverse and take us back down. This is not hopium or blind optimism. This is based on fresh data, technical analysis, and understanding the unique dynamics playing out in the silver market right now. Let me start by putting $85 in context so you understand where we are in the bigger picture. 2 weeks ago, on the last day of January, silver was trading at $75 after crashing from an all-time high of $121. In just 3 days, silver had fallen 41%, wiping out billions of dollars in leveraged positions and creating the most bearish sentiment we'd seen in years. At that moment, analysts were predicting silver would fall to $60, $50, maybe even $40. The consensus was that the entire rally from $30 had been a bubble built on speculation and leverage, and now reality was setting in. But something remarkable happened over the past 2 weeks. Instead of continuing to collapse, silver found a floor. It stabilized, consolidated, and then started climbing. First to 78, then 80, then 82, 83, and now we're at 85. That's a recovery of over 13% from the lows in just 14 days. More importantly, the character of the movie has changed. This isn't panic buying or a short squeeze. This is methodical, persistent accumulation driven by real fundamental catalysts. And now that we've broken through 85, we're entering a zone where the technical and fundamental picture suggests the path of least resistance might be significantly higher. Here's why $85 is so important from a technical perspective. When you have a massive decline like we saw from 121 to 75, traders watch for certain retracement levels to gauge the strength of any recovery. $85 represents approximately a 38% retracement of that decline, which is a significant technical level. Breaking through this level signals that the selling pressure from the crash has been absorbed and that buyers are in control. It's the point where the narrative starts to shift from talking about how far we fell to talking about how high we can go. The next major resistance level above 85 is around $90 to $92. This is where things get interesting, because this zone represents a 50% retracement of the crash. In technical analysis, when you recover 50% of a major decline, it's often interpreted as a sign that a new uptrend is establishing itself, rather than just a temporary bounce within a larger downtrend. If silver can push through 92 and hold above it, the bears lose their argument, and the bulls take full control. From there, the path is relatively clear toward $100. But technicals alone don't move markets, fundamentals do. So let me break down the specific fundamental catalysts that are setting up silver for a potential run to $100. The first and most important catalyst is the complete reversal in Federal Reserve policy expectations. When silver crashed in late January, part of the trigger was the nomination of Kevin Warsh as Fed chairman. Warsh is known as a hawk who favors high interest rates to fight inflation. That hawkish expectation strengthened the dollar and was bearish for precious metals. However, over the past 2 weeks, economic data has been consistently weak. Retail sales unexpectedly stalled. The GDP control group actually fell 0.1%, a negative number. Consumer spending is showing clear weakness. When the economy is this soft, even the most hawkish Fed chairman has to consider cutting rates to avoid pushing the economy into recession. As a result, the market is now pricing in roughly 60 basis points of rate cuts by the end of 2026. That's 2 to 3 quarter-point cuts over the course of the year. Lower interest rates are jet fuel for precious metals. They reduce the opportunity cost of holding non-yielding assets like silver, they weaken the dollar, which makes silver cheaper for international buyers, and they signal to markets that the economy needs support, which drives safe haven demand. This shift from expecting no rate cuts to expecting 60 basis points of cuts has completely changed the calculus for silver. If this trend continues and the Fed ends up cutting more aggressively, potentially 75 or even 100 basis points, it could accelerate silver's move toward 100 and beyond. The second major catalyst is the rotation away from dollar-denominated assets that's happening right now. This is bigger than just silver. This is about a fundamental reassessment of where safety lies in the global financial system. Investors are increasingly concerned about policy uncertainty in Washington, the massive and growing U.S. national debt that now exceeds $35 trillion, geopolitical tensions around the world, and the sustainability of current fiscal and monetary policies. When these concerns grow, investors start moving capital out of traditional dollar assets and into hard assets that can't be printed or devalued by central banks. We're seeing real evidence of this rotation in market flows. Both gold and silver are rallying together, confirming this is a macro-driven safe haven move rather than something specific to silver's industrial applications. The dollar has been under pressure, and perhaps most importantly, there's increasing discussion among foreign central banks and sovereign wealth funds about diversifying reserves away from dollars and into precious metals. If this trend accelerates, it could drive sustained buying pressure that pushes silver significantly higher. The third catalyst, and this one is critically important for understanding why the move from 85 to 100 could happen quickly, is the physical market dynamics. While silver futures crashed in late January due to forced liquidation, the physical market has remained extremely tight and is actually getting tighter. Inventories at major exchanges in London, New York, and Shanghai are at critically low levels. Silver inventories at the Shanghai Futures Exchange recently hit their lowest level since 2015. That's a 9-year low in physical inventories. When inventories are this tight, it doesn't take much buying pressure to move prices significantly. Think of it like trying to buy concert tickets when there are only a few seats left. The price can spike quickly because supply is so constrained. In the silver market, we're seeing rising lease rates, which are the cost to borrow silver for short periods. Rising lease rates indicate genuine difficulty in obtaining physical metal, not just paper shuffling in futures markets. Mints are reporting shortages of silver bars and coins. Premiums for physical silver above the spot price remain elevated. This tightness in the physical market creates a situation where if investment demand continues to increase, which it's forecast to do by 20% in 2026, there simply isn't enough readily available supply to meet that demand without prices moving significantly higher. The silver market is expected to be in deficit for a 6th consecutive year. That means demand exceeds supply for the 6th year in a row. 6 years of persistent deficits have drawn down inventories to the point where the market is vulnerable to a supply squeeze. If that squeeze happens, the move from 85 to 100 could be swift and violent. Let me give you some context on just how dramatic silver's performance has been over the past year, because this helps you understand why $100 is not some pie-in-the-sky fantasy, but actually a reasonable target. Even after the crash and recovery, silver is still up over 160% compared to 1 year ago. It was trading around $31 in February 2025. Today at $85, that represents a gain of over 162%. For comparison, the stock market gained maybe 15 to 20% over that same period. Silver has massively outperformed almost every other major asset class. This extraordinary performance over 12 months tells you that real fundamental forces are at work, not just speculation. The supply deficit is real. The growing industrial demand from solar panels, electric vehicles, AI infrastructure, and data centers is real. The rising investment demand as Western investors wake up to the silver story is real. These structural drivers haven't disappeared just because we had a crash driven by excessive leverage. In fact, the crash probably strengthened the market by flushing out weak hands and speculation, leaving a more solid foundation of investors who understand the fundamentals and are willing to hold through volatility. Now let me share what major banks and analysts are saying about where silver goes from here, because their forecasts align with the idea that $100 is the next major target. UBS just released a forecast predicting silver will return to $100 by next month, March 2026. That's less than 30 days away. They see a 17% gain from current levels as the fundamental drivers reassert themselves. Their view is that the crash was a leverage-induced liquidation event that temporarily dislocated prices from fundamentals, and now the market is correcting back toward fair value. However, UBS also notes they expect silver to fall back to around $85 by the end of 2026. Their concern is demand destruction at elevated prices. With more than 50% of silver demand coming from industrial applications, they worry that manufacturers will successfully reduce their silver usage as prices stay high. But even if they're right about the year-end forecast, that means the trade from 85 to 100 over the next month could be very profitable, with a 20% gain in just 4 weeks. On the more bullish end, analyst Alan Hibbard from Gold Silver expects silver to perform even better in 2026 than it did in 2025, when it gained 147%. He wouldn't be surprised to see silver rise by over $100 from current levels, potentially reaching $175 or even $200. His thesis is based on the structural supply deficit continuing for years to come, the accelerating demand from the energy transition, and growing recognition that silver is one of the most undervalued assets relative to its fundamental supply-demand dynamics. So with all these bullish catalysts and forecasts, what could stop silver from reaching 100? What are the risks and what should you be watching to determine if this thesis is playing out or if we're about to get hit with another reversal? The first major risk is the upcoming economic data. There's a delayed jobs report expected this week that could significantly impact silver. If the jobs report shows major weakness, significant job losses, or rising unemployment, it would reinforce the Fed rate cut narrative and likely trigger another surge in precious metals. Silver could blast through 90 on its way to 100. But if the jobs report comes in stronger than expected, showing resilient employment and suggesting the economy isn't as weak as recent retail sales data indicated, it could cause a sharp reversal. A strong jobs report would allow the Fed to delay rate cuts, strengthen the dollar, and put pressure on commodity prices, including silver. In that scenario, we might see profit taking from 85 back toward 80 or even 78. This jobs report is absolutely critical, and the market is going to react violently in one direction or the other depending on what the data shows. The second risk is technical resistance. I mentioned that $90 to $92 is the next major resistance zone. There are going to be a lot of traders who bought silver at higher prices during the run-up to 121 and held through the crash. They're sitting on losses, and they're looking for any opportunity to exit at break-even or smaller losses. When silver approaches 90 to 92, we're going to see selling pressure from these trapped longs trying to get out. If buying pressure isn't strong enough to absorb all that selling, we could stall out and consolidate or even pull back. The third risk is the Chinese Lunar New Year holiday that runs from February 16th through 23rd. China is one of the largest consumers of silver, both for industrial use and investment. When Chinese markets are closed for the holiday, global trading volumes typically decline and liquidity thins out. In a market that's already volatile, thin liquidity can lead to exaggerated price swings in either direction. Some traders might choose to reduce positions ahead of the holiday to avoid getting caught in volatility, which could create near-term selling pressure even if the longer-term outlook remains bullish. The fourth risk is simply profit-taking. Silver has rallied over 13% in 2 weeks. Some traders who bought at 75 or 78 are sitting on nice gains, and they might decide to lock in profits rather than risk riding it back down. If enough traders take this approach at the same time, it can trigger a cascade of selling that pushes prices lower in the short term, even though the fundamental picture remains positive. So given all these factors, what's the most likely scenario? Let me walk you through my analysis of what happens next. I think there's about a 60% probability that silver reaches $100 over the next 4 to 6 weeks. The fundamental setup is just too strong. The Fed rate cut expectations are real and growing. The safe haven rotation is happening with genuine institutional flows. The physical market is legitimately tight with inventories at multi-year lows. And the structural supply deficit provides a fundamental floor under prices. However, I don't think it's a straight line from 85 to 100. I expect we'll see some consolidation, probably in the 83 to 88 range, over the next week or so. The market needs to digest these gains and build energy for the next leg higher. We'll probably test the 90 to 92 resistance zone, possibly pull back once or twice as trapped longs exit, and then if buying pressure is strong enough, break through decisively. Once we're above 92, the path to 100 opens up fairly quickly because there's less overhead resistance, and momentum will attract new buyers. There's about a 30% probability in my view that we consolidate in a range between 78 and 92 for an extended period, potentially several months. In this scenario, the move to 100 takes longer than UBS predicts. We chop around in this range as the market works through the psychological damage from the January crash, waits for more clarity on Fed policy, and builds a more solid base of support. Eventually, we break out, but it happens later in the spring or summer rather than in March, and there's about a 10% probability of a bearish scenario where we fail at current levels and head back down to retest the $75 lows or lower. This would require several things to go wrong simultaneously. The jobs report would need to come in much stronger than expected, the Fed would need to push back hard against rate cut expectations, the dollar would need to rally significantly, and industrial demand would need to show clear signs of collapsing. I give this scenario low probability because it requires too many things to align against silver when the weight of evidence is currently positive. For anyone trying to figure out what to do with this information, whether to buy, hold, or sell, here's my framework. If you don't currently have any silver exposure and you believe in the fundamental thesis of supply deficits, Fed rate cuts, and safe haven demand, then current levels around 85 represent a reasonable entry point with defined risk. Your stop loss would be a break below 80 or 78. Your upside target would be 100 or higher. That gives you a risk-reward ratio of roughly 1 to 3, meaning you're risking $5 to $7 to potentially make 15 or more. That's an attractive setup. If you already own silver that you bought lower, at 75 or 78 or even earlier, you're sitting on nice gains, and the question is whether to take profits or hold for higher prices. My view is that if you believe in the long-term bull case for silver based on structural supply deficits and the energy transition, then you should hold through the volatility. Consider taking partial profits, maybe selling 25% of your position to lock in some gains, but keep the rest for the ride to 100 and potentially beyond. Use a trailing stop loss to protect profits while giving the position room to work. If you're a trader rather than an investor, looking for shorter-term moves, then current levels are tricky. We've already rallied 13% in 2 weeks, so chasing here carries risk. Better to wait for a pullback to 82 or 80 and then enter with a tight stop below 80. Or wait for a confirmed breakout above 90 with strong volume and enter on the momentum, targeting 100. Trading requires more active management and willingness to take losses quickly if you're wrong. One thing I want to emphasize is that whether silver reaches 100 in the next month or takes 6 months to get there, the bigger picture remains compelling. We're in a structural bull market driven by supply deficits that have persisted for 6 consecutive years and show no signs of resolving. Global mine production of silver is forecast to increase only 1% in 2026, while investment demand is forecast to surge 20%. That's a recipe for higher prices over time, regardless of short-term volatility. The energy transition to solar power and electric vehicles is creating new sources of silver demand that didn't exist a decade ago and are only going to grow. Each solar panel requires silver, and global solar capacity additions are growing at double-digit rates annually. Electric vehicles contain significantly more silver than traditional cars, and EV adoption is accelerating. Artificial intelligence infrastructure requires massive data centers filled with servers and electronics that use silver. These are multi-decade trends that should support silver demand for years to come. Silver's role as a monetary metal and safe haven asset is being rediscovered by investors who spent years focused only on gold. The U.S. government recently included silver on its list of critical minerals, recognizing its strategic importance. More countries are looking to diversify reserves away from dollars. These developments support investment demand independent of industrial consumption. So when I say 85 might be the last stop before 100, I'm not being reckless or overly optimistic. I'm looking at Fed policy turning more dovish, safe haven flows accelerating, physical inventories at 9-year lows, structural supply deficits persisting, and major investment banks forecasting $100 within weeks. The setup is there. The catalysts are in place. The technicals are constructive. Now it's a matter of watching how the market responds to upcoming data and whether buyers have enough conviction to push through the resistance zones. Watch the jobs report closely this week. If it's weak, start preparing for a move toward 90 and 100. If it's strong, expect consolidation or a pullback that creates a better entry point. Watch whether we can hold above 83 on any pullbacks, because that would confirm the uptrend remains intact. And watch volume, because moves on strong volume are more sustainable than low volume drifts. $85 might be the last stop before 100, but like any journey, there could be some turbulence along the way. The question is whether you're positioned to take advantage of it when it happens.